Why silver is back in the spotlight? In times of financial calm, silver is rarely mentioned. Stocks dominate headlines. Cryptocurrency grabs attention. Interest rates fill the news cycle. But history shows us something important. Silver only becomes news when something deeper is wrong. Over the past year, analysts and investors noticed an unusual development. Bank of America, one of the largest financial institutions in the world, referenced a theoretical silver price of $309 under extreme financial stress conditions. This was not a forecast. It was not a price target. It was a warning. At the same time, physical silver premiums, the real-world cost to actually obtain silver, began rising sharply. In some cases, silver coins and bars sold for far above the official market price. Today's documentary explores what this really means. We will separate fact from speculation, we will explain complex ideas in simple terms, and we will look at why silver, once again, is quietly signaling stress in the global financial system, what Bank of America actually said, and what IT didn't headlines often exaggerate. So let's slow down and clarify the facts. When Bank of America mentioned a $309 silver scenario, it appeared in research commentary, not a trading recommendation. Large banks routinely run stress tests, models that ask, what if inflation accelerates? What if currencies lose credibility? What if investors abandon paper assets? In these models, metals like silver and gold often rise sharply because they are not tied to debt. So what does Bank of America surrenders really mean? It means the bank acknowledges something critical. Under extreme conditions, the current pricing system may not hold. That alone is significant. Banks do not speak casually about breakdown scenarios. When they do, it reflects growing uncertainty beneath the surface of the financial system. Understanding silver, more than just a metal, silver is unique. Unlike gold, which is mostly stored and rarely used, silver has two roles. A monetary metal and industrial necessity, silver is essential in solar panels, electronics, medical equipment, electric vehicles. At the same time, it has been used as money for thousands of years. This dual role means silver reacts not just to fear, but also to real supply and demand pressures. When economies slow, industrial demand matters. When trust weakens, monetary demand rises. Few assets sit at this intersection. Paper silver versus physical silver. The core of the issue to understand today's silver story, we must understand a critical distinction. Paper silver, this is silver traded through futures contracts, exchange traded funds, derivatives. Most paper silver is never delivered. It exists as a promise. Physical silver. This is tangible. Coins, bars, industrial silver shipped to factories. Here's the problem. The amount of paper silver traded is many times larger than available physical supply. This works as long as people don't demand delivery. But when confidence weakens, people stop trusting promises and demand the real thing. That's when stress appears. Why physical silver premiums are rising. Let's talk about premiums. The spot price of silver is the quoted market price. The premium is the extra cost to actually buy physical silver. In recent years, premiums have risen due to limited mint capacity, rising production costs, supply chain disruptions, increased retail demand, strong industrial consumption. What's important is not the price alone, but the gap. When physical silver sells far above spot prices, it signals scarcity in the real market. This is not speculation. This is basic supply and demand. Historical silver disconnects, a repeating pattern. This phenomenon is not new. 1970s inflation crisis. As currencies lost purchasing power, silver surged. Physical metal became increasingly difficult to obtain. 2008 global financial crisis, paper markets froze. Physical silver vanished from retail markets. Premiums spiked dramatically. 2020. Pandemic shock, spot prices briefly collapsed, yet physical silver became scarce almost overnight. The lesson is consistent. During crises, paper prices can fall while physical prices rise. Silver doesn't lie. It reflects stress early. Why banks monitor silver closely. Banks do not watch silver for entertainment. They watch it because silver reveals leverage in financial markets, confidence in currency systems, pressure in supply chains. Silver often reacts before inflation shows up in official data. So when banks discuss extreme silver scenarios, they are not promoting metal ownership. They are measuring fragility. The $309 number is less about silver and more about what happens when confidence breaks. Is $309 silver realistic or a warning sign? Let's be responsible and realistic. A $309 silver price would require severe currency devaluation, breakdown in bond markets, major financial restructuring, prolonged supply shortages. This is not a base case. It is a stress scenario, a reminder that systems built on leverage are vulnerable. The message is not fear, the message is awareness. What this means for ordinary people, for most people, this isn't about buying silver tomorrow. It's about understanding why inflation keeps returning, why trust in institutions matters, why physical assets are discussed again. Silver acts as a signal, not a solution. When it flashes warnings, it's worth paying attention. Conclusion. Let's summarize calmly. Bank of America did not predict $309 silver. They acknowledged extreme risk scenarios. Physical silver premiums are rising due to real constraints. History shows silver reacts early to financial stress. The true message is system fragility, not hype. Silver doesn't shout. It whispers, long before crises appear in headlines. If this documentary helped you understand what's really happening beneath the surface, like the video to support the channel. Share your thoughts in the comments. Do physical markets matter more than paper prices? And subscribe for calm, documentary-style breakdowns of the financial signals that shape our world. Thank you for watching, buddy.